Hi, Paul Gerard from Price Accounting Services, back again for another video in our channel on investing. And in this video, we're going to look at how to maximise deductible loan interest. There's a number of key strategies in this one, and it's an important one if you have borrowings that you're using to acquire any equities or investments, as it will give you some tips on how to keep that maximised. So let's get into it. The general principle to interest deductions is that interest must be incurred to produce assessable income. We covered that in the prior video, which looked at deductible investment costs. So that really has two limbs to it. The first one is there must be investment income, and the interest was incurred to produce the income. So no income, no deductions, simple rule. Now, many investors don't think through the intent, and it's possible to maximise deductible intentions here while at the same time to reduce non-deductible debt, i.e. you can debt recycle by being clever. And it's not a scheme, okay? So let's talk about debt recycling. So debt recycling is the process where a taxpayer may pay down a debt to then later redraw a new facility, clear and clean, for later use for a different purpose. Now, an example of that might be you've paid down a good part of your home loan. You approach your lender and you say, can I split? Split creates a new portion of a loan. Can I split out my home loan because I want to use it to buy some equities? And the lender says, no problem. Next thing, they create a $50,000 loan split, still secured by your home. Remember, it's not your home that gives rise to the deduction, it's the use of the borrowed money. So if you use that loan split to buy investments, you have recycled possibly some deductible or non-deductible debt by paying it down, using it as a split into tax-deductible use. So this might allow the investor to maximise the interest deductions and minimise non-deductible debt without overall debt changing. So we often find people do this where they might have paid down or accumulated large amounts in an offset against their home, and they seek to gain a loan split for equities. Okay. Now, a word of guidance, warning, advice here is that issues surrounding debt recycling really should come from a licensed credit advisor. So if you ring me and ask me, can I debt recycle it, things like that, I certainly can't say yes. Matters of credit require licensed advice, so your broker is the best contact point there. If you don't have a broker, we're more than happy to steer you towards those we know who are very good at debt recycling knowledge and explaining these things. Okay, so that's... Now the second point to deductible borrowings is using the deductible debt efficiently. Now what does that mean? By maintaining the shares, the investment-specific use for nothing else other than investment. Just because it's deductible doesn't mean you want to leave the borrowing there. Getting it wrong and using the loan incorrectly can erode, minimise, or even taint your deductions. So I'm going to share with you my practical rules for equity type investment loans and how to maintain them to maximise your deductible use. Okay. So you only ever draw the proceeds down to directly settle each purchase. So don't draw down $50,000 and put it in the cash account with CommSec or AussieX or whatever, and then only invest $20,000 of it, because part of it's now sitting in a cash account that doesn't earn any income, and so that portion you're paying interest that is not deductible. That makes no sense. So only draw the proceeds to settle each purchase directly or clear it directly to the settlement account, etc. Okay, that's rule one. Rule two, do not credit income to the loan. Credit a non-deductible loan if any, or use an offset on that non-deductible loan. And lastly, if you had to, maybe credit it to an offset on the deductible loan if you have no other alternative. Third rule, when you sell investments, this is an important one. When you sell investments for a profit, do not credit the sales proceeds directly to the loan. The reason for that is the amount you reduce off the loan needs to follow Rule 4. Okay, Rule 4. When sales settle, only repay the loan following these two rules. So A, if sold at a loss, credit the loan with the full proceeds received. What this does, it leaves the deductible interest for your loss. Kid you not. So you buy shares for 10,000, you sell shares for 5,000, you still have 5,000 deductible loan, yet you don't own the shares. It defies logic because you would think the normal principle applies that when you dispose of an investment, the interest ceases. However, where it's sold for a loss, the loan interest continues indefinitely. So if you don't taint your loan, you've protected yourself. So that's A, when selling for a loss. B, when selling for a profit, only ever credit the loan with the original cost of the purchase. So let's use an example. You buy 10,000 of shares, you borrowed the money. You later sell at 15,000. Don't repay the loan by 15, otherwise you're eroding your deductible amount. Reduce what you originally borrowed, 10,000. Okay? So, if you follow these rules, you're going to maximise and use your debt efficiently. There's another means you can issue here with borrowings. Avoid blending loans. Now, to blend a loan, you can do it by mixing income producing and non-income producing investments. Okay, that's going to be a problem. So, for example, you go out and buy VAS, Vanguard Australian Shares Fund units, and you buy $10,000 worth of those, and you also buy $10,000 worth of some Bitcoin, for example. You take the punt that it's going to go up in value. You then have to have a basis to apportion your loan. The ATO will expect this because the portion of interest that relates to crypto will be a CGT issue for the crypto, and the portion that relates to the shares. Now, if you've then bought and sold shares and buy other shares, etc., that could be an incredibly messy, complex calculation. So don't blend it to start with, would be my tip. Alternatively, you might have two loans. You might have a loan for your CGT acquisitions and a loan for your deductible acquisitions. Okay. Another way not to blend a loan is be careful with repaying sales. So if you sell investments in your trading account, you sell, for example, you bought 10,000 of CBA, deductible interest, no problem. You buy some CBAs, and then for whatever reason you sell the CBAs and you buy some NAB. Still deductible, loan's still okay. Then you sell the NAB and then you buy some crypto, and then you go, whoops, shouldn't have done that. I'll sell the crypto and buy something else. Now, you're mixing your borrowings up. So be very careful not to do that, and also using the loan for any other purposes. Another tip for any borrowing is to avoid blending loans. And this can be done in a few ways, chiefly through mixing the income producing and non-income producing investments. So for example, if you've gone and bought some CBA, bank shares, VAS, etc., and then you've also gone and bought some Bitcoin, you're going to have an apportionment issue for each day. It's very complex sometimes, and the ATO would query that and say, how did you determine that? How did you apportion it? Show me your calculations, and so forth. An alternative to that might be to have two loans, one for CGT acquisitions versus that of income producing acquisitions. That will avoid that problem. Alternatively, seek to avoid it as much as possible. Then the other way is through not repaying sales. So you can actually blend that way. So for example, let's think of it this way, that in your securities settlement account, you've gone and sold your CBA shares, you then sold some NAB shares, and you've gone and bought some ANZ shares, all income producing, but you also then gone and bought an ETF that has no income producing potential, and then you sell down some of your NAB shares, and then you buy something else. Next thing, how much of your loan really relates to each purpose and for each day, and you've tainted it. Made a complete mess of it. The ATO will also then say, well, we need to see a reasonable apportionment. Sometimes we find people try and take a very simplified view to that. For example, they say, well, for example, I used 2,000 of the loan for my property, it's still deductible. Well, yeah, okay, it might still be a deductible purpose for that property, but you have to split the interest and show each in its relevant area. Have you calculated it correctly? Have you calculated it well? And commonly the answer to that will be no. So avoid it. So there's some of my tips with maximising loan interest, and I hope you've found that helpful. And we hope you enjoy further videos in this series on investing, and we hope to see you soon. Cheers. Bye.